In this video, we are going to talk about most promising sectors going into the future according to professional traders. So before starting, please like this video and subscribe to this channel for our future updates. To maximize profits, the top-down investment method begins with a thorough analysis of the economy and the strength of various sectors, followed by the selection of the most promising companies within those sectors to maximize returns. The sectors and equities within those sectors that are performing well can be selected by investors if the economy is performing well. Even though the economy as a whole is struggling, there may be sectors and companies that are defying the trend and functioning well. Investors might attempt to generate larger returns than the market by identifying the hottest sectors that are driving the market higher and then identifying the finest companies within each of those sectors. Understanding how to find the right stocks and sectors. You want to buy companies that have the greatest potential to be large winners if your analysis indicates that the market is in an uptrend, also known as a bull market, and is likely to continue for some time. However, just because the market is trending upward does not imply that all equities will do well, or that some will outperform others by a significant margin. If the market is in a bear market, or if the price of a security falls, an investor can consider short selling. Short selling is a sophisticated strategy that involves betting on the price of a stock falling in value. It should only be considered by experienced investors. Short sellers find and sell equities that they believe will perform poorly, and then profit when the stock's price falls. Nevertheless, although the emphasis of this essay will be on uptrends, the same ideas apply to downtrends as well. Multiple time frames. Before deciding on a sector or stock, investors should spot a trend by examining numerous time frames inside a single chart. Charts can assist investors in determining the direction of a sector or stock's trend. A trend's time frame, or the length of time that it has been in existence, is critical information to have. Trends can be divided into three categories: primary, intermediate, and short-term. There are, however, a number of different time frames to consider. For example, a weekly or monthly chart would indicate an upswing, whereas a shorter time frame, such as a daily chart, might indicate a downturn in the market. As a result, when examining different time frames for a single sector or stock, keep an eye out for potentially contradictory trends. Identify the primary trend and determine if it appears to be robust or if it appears to be losing its steam. The use of a long-term chart to detect a trend, followed by intermediate-term and short-term charts to help drill down to the precise entry and exit levels, can be quite beneficial. Pick the right sectors. Certain sectors outperform others, so if the market is trending upward, we want to buy stocks in the sectors that are outperforming the rest of the market. To put it another way, we want to make investments in sectors that outperform the broader stock market. In the technology sector, for example, a 10% gain may be compared to a 3% gain in the whole market, as measured by a benchmark index such as the S&P Wink with tongue sticking out 500. By examining a variety of time frames, we can identify the most promising sectors that are not only performing well right now, but have also demonstrated strength over a longer period of time. In order to determine their investing time horizon, investors must choose the time frames that are most appropriate for them. Following that, we select a sector that is among the best performing in the country. Investors can diversify their portfolios by selecting a few of the most promising industries. We can also take a look at the chart of an exchange-traded fund, ETF, that is invested in a specific industry. The ETF would consist of a basket of securities that would track the performance of companies within a certain industry. It is recommended that a trend line establish the trend, with the ETF displaying strength as it rises away from the line. In an uptrend, the trend line simply connects all of the higher lows that have occurred, or the low points in the corrections. When an uptrend is in progress, each correction low should be in contact with the upward sloping trend line. A bounce off the trend line and in the direction of the trend should be seen if the trend is still in place. Pick the right stocks. Following the identification of an upswing in a sector that is outperforming the market, we must identify the stocks within the sector that we should consider purchasing. We could simply purchase a basket of stocks that represents the entire sector, which would likely perform quite well in the long run. We can, on the other hand, do better by cherry-picking the finest companies inside a particular sector. A sector's upward trend does not necessarily imply that all of the stocks within that sector will be excellent performers. The likelihood is that some of those stocks will outperform, and it is those stocks that we want to include in our portfolio. The technique for finding individual stocks is the same as the process for doing a sector investigation. Choose stocks within each sector that have experienced the greatest price appreciation over a variety of timeframes to ensure that the stock continues to perform well over time. Identify the stocks that have experienced the greatest price appreciation using multiple timeframes to ensure that the stock continues to perform well over time. The stocks that have done the best over a period of 2 or 3 timeframes are the stocks that we are interested in investing in. Study the charts of the best performers and draw trend lines on the charts to indicate where the price trend is most clearly defined. In order to discover prospective price gains while also taking into consideration the danger of losses, profit objectives based on chart patterns should be defined. Special considerations. It is important to note that there are other factors to consider when buying a stock. Additional criteria to look at include liquidity. Liquidity refers to the number of shares that are exchanged on a given day, allowing a stock to be bought or sold immediately. As long as there is liquidity, there will be a large number of buyers and sellers. Purchasing stocks with little trading volume makes it difficult to sell at a reasonable price if you need to liquidate your holdings quickly. Stocks with trading volumes greater than a couple of 100,000 shares per day should not be purchased by novice investors unless they are well versed in the market. Price. Many investors avoid investing in high-priced stocks and instead prefer to invest in low-priced equities. It's better to trade equities that are at least $5, if not more, over the current market price. Not that there aren't excellent cheap stocks or poor expensive stocks, but don't avoid a stock simply because it is expensive, or buy a stock just because it is cheap in terms of dollars because it is expensive in terms of dollars. ETFs. Over the years, the trading of exchange-traded funds, ETFs, has progressed significantly. If you do not want to hold a large number of individual equities, you may be able to discover an exchange-traded fund, ETF, that provides results that are somewhat comparable. The purchase of specific exchange-traded funds, ETFs, if desired, that may reasonably replicate the performance of individual stocks is not an issue. Exiting and rotating. Of course, there is no assurance that you will generate remarkable returns, but this technique does provide the opportunity to produce returns that are superior to the market. It is necessary to keep an eye on positions to ensure that the sectors and equities remain popular with the market. Remember to avoid overtrading, which can result in exorbitant commissions. This is why we employ different timeframes to help you avoid this. Whenever your stocks or sectors begin to lose favor across various timeframes, it is imperative that you shift your investments into sectors that are performing well, a process known as sector rotation, in order to maintain your position. When it comes to exiting holdings, your market research should serve as a guide. Breaking important trend lines within the stocks being held, or within the sectors being tracked signals that it's time to abandon the trade and hunt for fresh trade opportunities. The bottom line. Because sectors and the leading companies within those sectors may vary over time, this strategy will necessitate a certain amount of transaction turnover. With long positions in stocks that are leading the market upward in bull markets, and short positions in the weakest stocks that are leading the market lower in bear markets, the goal is to profit from the market's upward momentum. This is accomplished by identifying the hottest sectors, in the context of a bull market, over a period of time, and then identifying the best performing equities within each of those sectors. We have a decent possibility of earning above average returns if we invest our funds in the best performing equities on a regular basis. What do you think of our video? Let me know in the comments section below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.